My name is Scott Livengood. I'm the Assistant Director of the Kelleher Center next door at the McCombs School of Business. Welcome to our current edition, I guess, of Money Talks. I guess I'm introducing myself here to a certain extent, but we have Barrios from the Mountain Nazca venture capital firm. And so we're going to have a discussion here. Probably going to be about 30, 45 minutes, and then in which case we'll open up for questions and answers. I'll go till about 7. And then we'll have some opportunities to mingle a little bit on the foyer when we're done.
Thanks, Scott.
Great, thank you. Welcome, happy to have you here. So we understand you flew in from Mexico City today.
Yes, we flew in this morning, staying till the end of the weekend.
Well, great. Well, we appreciate you coming all this way to meet with us.
Thanks.
And yeah, so tell us a little bit about Mountain Nazca. Do you have any particular focus or purpose, mission?
Yes, Mountain Nazca was founded 2014, so we recently started, we recently launched. 4 years sounds pretty far away, but it's been quite a ride. It was founded by my partner and another Chilean partner, both Endeavor. I don't know if everyone knows Endeavor here, but it's a society of entrepreneurs, and they help each other out. So it's kind of a big networking, say, institution. Very important in Mexico and somewhat in the U.S. and worldwide. They started the company with a bottom-up approach. It was called Nazca Ventures before that. Nazca, I don't know if anyone knows, but it's a tectonic plate that covers basically all LATAM. So it was kind of the essence of building something together with Latin America. After that, we started investing. We basically started because we lacked a lot of technology in Mexico. So we started company building. What this means is we basically created our own companies because it was difficult to find some of the investments. So we launched 3 companies within. So we basically created companies, and then we hired the co-founder, right? We interviewed them for the capabilities, all that stuff, blah, blah, blah. And then we launched them, and some of them are still alive. Some of them have obviously been written down. Okay. Yeah. And in 2015, another company builder, but a little bit more international, called Mountain Partners, looked us up and obviously was interested because of our approach in Latin America. And basically they bought us out. Well, not bought us out, but they bought our first portfolio out and a little bit part of the GP. So in that sense, we kind of came together and we partner up with them. And that's why we're called Mountain Nazca now. Okay. So it was a huge thing for us because it had never happened before in Mexico and Latam where a fund has been bought out. So it's a little bit of a track record there for not only for our limited partners, but for us as well, right? So I joined Mountain Partners. I was actually the first co-founder of Nazca, one of the companies. And afterwards, we recently we're about to selling that company. I know that in the CV it said I sold it, but
not quite yet.
We've been there for a year, so I've been like on that regard for a while now. So that's where we are now. We're fundraising our second fund. We invest. I think a particularity is we invest in Mexico and LATAM as well as in the U.S. So we focus not only in Mexico. We started investing in Mexico, then LATAM, and then we started investing in Latin Americans in the U.S. And then with the network, we started growing, and now we invest in also companies in American and obviously international.
Great. That sounds very interesting. Yeah. So you say you're in the process of fundraising. So what are some of the characteristics you look for in investors to fund these activities all over?
I think there's different kind of investors, right? There's institutional investors, which could be a pension fund, which could be another institutional, bigger fund. And then there's family offices, and then there's obviously high net worth individuals. We basically describe ourselves as venture capital being the second feeder of the feeding, because first are the entrepreneurs, then there's the venture capital. So entrepreneurs raise money every a year and a half. We fundraise every 3 years, and then private equity every 4 years. So we're like the bottom feeders, right? So what we look in, for us at least, is limited partners that actually add value. how do they add value? It's an interesting concept because since we are not experts, right?
In everything.
No, I mean, now nobody can consider themselves an expert only if it's like real estate, which has been here for the past, I don't know, our existence, right? So that can be something you can be an expert on. But in technology, it's changing so fast that nobody can be an expert, right? So our investors have a little bit more experience than us. Obviously, we have the experience of investing and trying to find the correct people, and that's what we do. We invest in the people. Obviously, we invest in the technology, but the people is the core of the company. If the people suck, then the company most probably will suck too, right?
Yeah. That's a technical term, I believe. Yeah, right.
So it's kind of that, right? That's I think the most important thing that, of investing is that. So that's also our LPs. So we try to look for those LPs that we know that are going to add value. Obviously, their money is worth a lot, but we look for smart money as well as when we're an entrepreneur that we're looking for smart money. So that's what we do. Right now, we cannot get in. Well, we're looking for as few institutional investors as possible because we are still looking to add as much value as possible.
So beyond simply the financial capital, you talk about networking, you talk about expertise.
Correct.
So some of these other, and I remember reading about legal services and other things that you kind of bring to helping the startups. Talk a little bit more about, I guess, some of that expertise.
So here's one example. One of our companies called Urban, which is, I think you have it here, it's like Chariot in Mexico. But in Mexico, there's a huge problem of transportation. So the public transport is terrible. So we try to actually deploy that. It's part of one of the company building companies that we deployed this year. It's extremely successful, right? In August, there's the syndicates, the taxi driver syndicates, just basically deployed, how do you call it, like, say a media stunt in collaboration with the government, right? So this is huge because in Mexico, there's some corruption. I don't want to make it bigger.
Alleged.
Yeah.
Right.
So that's a huge problem for us because there's something that we're trying to solve, and obviously the government is bringing us down because syndicates give them money for having access to all this. So through our network, we were able to actually make the company succeed and be part of a technology company again and try to solve problems, right? So that's one of those kind of problems that we try to solve with the network. Obviously, ourselves, we're not politicians. We don't do lobby, so we try to do that as much as possible. That's one, and obviously capital involves a lot, and then there's growth, right? Sometimes we have another company called Kavak, which is like a BP. Well, it used to be, now it's Carvana, the biggest one. So they're raising debt. So now you have to go out, and obviously they put us in contact with big banks to give us access to that debt. So it's kind of that network that we're looking for.
Great, yeah. And so you mentioned the people in which you're investing and the firms and things. So what do you look for in either the characteristics or the experience or maybe the lack thereof when you think about investing in those people?
That's a very good question. I think it's a mix of everything, right? It's the stamina, which is basically how people react to certain problems, right? The criteria, obviously, education works, but everybody knows here that Dell is a dropout, Michael Dell, and there's a bunch of those that we can describe everywhere. So I don't think education is the core thing that people look on. I think it's more that people understand and that they're passionate about what they do and that they're in need of something and that they actually know what is their vision of the company. So I think that's the best way to really look at what anyone that wants to start a company should have. Obviously, passion is the first thing, and if there's no passion, you can immediately feel it. It's not like me trying to sell, I don't know, toilet paper, right? Waking up and wow, this is the best day of my life. I'm selling, but that kind of passion dies eventually, unless there's
authentic
real
passion.
exactly.
Yeah, yeah.
Exactly.
So passion is an interesting, I guess, characteristic, because you certainly want somebody to believe in their product, believe in their idea, and have the determination to see it through. Yet you also need somebody who is teachable, who's willing to compromise and listen to the advice and expertise of the people that would bring in. So how would you balance, I guess, that kind of a
That's a great point. Actually, when we're looking for someone, is not only their capacity or their talent, is actually their capacity to retain that talent within the company. Because you can be great, but if you cannot transfer that greatness to your people and those people actually following you because you're great, then all those great people that you hired are going to run as fast as they can to somewhere that they feel valuable at. So we don't only interview them, we try to interview as many people as possible within the company.
Great. And so do you typically look for very early stage companies, or some that are at least have some kind of revenue or prototypes, or kind of where is your sweet spot as far as development?
Well, VC, as you know, is basically growth or startup money, right? So we've seen a certain trend in the industry from the past 3 years to now that the seed, remember that you have the angel part or bootstrapping first, then you have the angel side, then you have seed, and then you have Series A, B, C, up to double E, C, double E. So we've seen that the seed is a sweet spot, but the seed has been pulverized. I don't know, now you see, let's do a convertible note A, convertible note B, and then give me 200,000, 100,000. It's like milestones until you get to a Series A, where now is, instead of fundraising $3 million, now it's a $5 million round, right? So what that makes is a Series A is saying, now I want to see what those 50,000 convertible notes brought you to, right? So we like a seed, but a fully funded seed. So what we do, instead of funding you 200,000, we go like, how much do you actually need to reach a Series A? What that makes is people focus on operating instead of fundraising. Fundraising, I don't know if anyone here has fundraised. I myself have done that as an entrepreneur now.
Very time consuming.
Very time consuming.
Yeah, right.
People think that obviously it's a great idea. You love it because you're an entrepreneur. And you say, well, everybody's going to buy this. But that's not the case. You have to at least have 6 to 8 months of runway to fundraise, right? So that's very important for us, that people can actually operate and get their hands dirty of actually taking that concept to a revenue stream and start getting traction on that side. So we like, for example, our thesis is we're not shotgun approach. What this means is investments, you could be a VC investor that is aiming for 50 or 60 investments, and then
some of them will pan out, some of them won't.
Exactly,
so,
which is probability. Then you're on the round of probability, and you attain to that. We invest in 14 to 17 companies. Very sniper approach. We really do our due diligence, but we actually invest on that seed round between $1 and $1.5 million, which is going to take us to a Series A. And obviously, if we help them out with our team to reach that threshold, and then we invest majority, or we try to increase our participation on that. So those two are our best shots, but we've also gone in Series B investments.
Much later stage then. Yeah.
Just one, but we can actually do that as well if there's still a lot of runway.
Great. So you spoke about your experience a little bit raising capital. So tell us a little bit. Was venture capital always part of the plan? I mean, how do you go from a engineering major all the way through kind of the career path a little bit to take you to the VC world?
No, it was never the plan. But it was never the plan to be not a founder, but my startup was basically a Netflix, but for reading materials, right? So we had comic books. If my 18-year-old me would have said, you're going to be doing something about books, I would have shot myself, right? So you never know where it's going to take you. So really, it was the opportunity of actually doing a startup, right? And that's where I was talking about the passion. I'm a civil engineer, so I worked in real estate for like 6-7 years before I came to McCombs and did my MBA. When I came here, I was looking for becoming also an entrepreneur, right? So going back to Mexico, put up my shop, low-income housing, very, very focused, right? So I had my business plan before I came here. And when I left, I went back to corporate, right? So no, obviously, venture capital was out of reach. I tried to apply to a couple of venture capital funds here in the US, and it's very complicated. I don't know if you know, but there's like 900 VC funds, and there's 5,000 people working for the VC fund. So it's like a six people team average. So it's very complicated. Those timeframes close really fast. You have to be there, and you're really competing against everyone. Now, I think the most popular career is working for a VC or a private equity. Now, it's not investment banking anymore. Jobs have shifted because of the popularity of Uber and WeWork and all these billion-dollar companies that come up every week. So everybody wants to be looking at the billionaire or being the billionaire. So I think now we're not talking in millions like investment banking used to be.
Sure.
So I think they have shifted.
So would you invest in your own company now as a VC, looking back?
That's a trick question.
It is. I'm going off script a little bit for that.
Yeah, no, I know. I don't know. I don't think so.
Interesting.
Well, I think the market was going back. Obviously, I know I have all the background of why it did go. It's going as expected, but it didn't go as expected. You know, like the team was good. Well, obviously it's me, so I cannot talk about shit about myself. But I think the market wasn't there, and there's several things that did go through because we did execute. We have probably 75% of all the reading materials available in Mexico, so we're not talking about scarcity of value proposition. But there's no access to credit cards, there's no cash in hand, and there's no availability like in the US that people actually, they're early adopters. Right? In Mexico, we are not early adopters. If you try to do a Netflix in Mexico, it would have basically gone south from day one. So considering that, no, I wouldn't have invested in myself.
Interesting, yeah. So your background, you've done a lot of different types of financial investing. So there's, you worked in private equity, investment banking, as an angel investor, now as a VC. Well, could you maybe compare and contrast a little bit of those various methods of financial capital or sources of financial capital? Do you see advantages or disadvantages from one over the other?
I think everyone I talk to, even coming from bigger funds, $500 million funds in Mexico or in the US, everybody suffers when they're fundraising. It doesn't matter where you are, what kind of financing or investments you do, there's always trouble with money, right? Well, obviously, money is huge now, and you see all this money going around, but still the sophisticated investors do actually look at what you are doing or what your thesis is, and they look at the team. So it's always a team that they look for. Availability of capital has gone up. I mean, you've seen, now the SoftBank, $100 billion fund. It's crazy, right? Bitcoin going up to 260 billion. Crazy, right? Ethereum, now you see new access to capital, ICOs. What are these? Are these scams? Are these not scams? How easy is to do this? Well, how many CTOs are there? There's a lot now, right? So creating a new ICO is fairly quick. You can do it in 4 weeks if you try to convince people. So I think times are changing, definitely, in access to capital. Debt will always be debt. Venture capital will always be venture capital. Now, are we going to compete with ICOs? Well, yes, but now who's going to monitor those ICOs, right? So definitely, I think as an investment banker, you're always looking for someone to fund that or someone to sell something. So private equity is the same. You have access to funds. You have access to pension funds, which are huge, but still, they're looking for a very specific approach. Pension funds need to diversify, right? So they know that they have to put 16% into alternative assets, right, and some to commodities. So it's always going to be the same, but I think opportunities are going to be larger now. So everybody thinks it's easy to create $1 billion company just because you can see them every week.
Right, right.
But how many companies are created now versus 20 years ago?
Sure.
Right. So
sure.
I think that's the huge difference, right?
Yeah. So you mentioned things like cryptocurrencies, and I see crowdfunding increasing in popularity, and all these. Do you see those as a threat from the VC world, or is it maybe you can work hand in hand, or would you look at a firm and say they raise so much versus crowdfunding, that's a positive signal that there's a market there are customers there, this is something we want to perhaps invest in, or is maybe a mixed signal as far as what those earlier stage investments might mean?
It depends on who you're, well, in my case, or in our case, threats are always good, right? It takes you out of this comfort zone, of the status quo. If you think it's a threat, then you're doing something wrong, right? If the status quo is on your side, then obviously the deal flow that you're getting in is not very good, right? Because you're having the access to capital, you have the capital, and sometimes you get this deal and you go like, I don't know, right? Because I have the money. If that's where you are, then obviously the whole system is wrong, because you need to be looking at the huge and the great companies. If you see that great company, you're going to be throwing money at them, right? So a threat, well, you either adapt or you die, right? So it's the same thing. So Blockbuster didn't believe the Netflix was a threat. So if they would have done something, they would be alive now. So that's kind of the same thing goes on venture capital. If you're investing in technology companies, innovation, and you're not innovating, well, hell, what are you doing?
Sure,
right?
Sure. You can't expect the firms to innovate and you not innovate at all. So you have to kind
exactly.
Of
so on that innovation, one of our funds is called Alter Ventures. That we launched it with another partner in San Francisco and invest in video games. It's a completely new way to invest in video games. We're investing in the IP, so in the intellectual property, instead of investing in the company itself, because we've seen how the trends work. And given the circumstances of actually cryptocurrencies coming out, then we're looking at probably launching an ICO, right? Why? Why does it make sense? Because there's a huge community. ICOs are basically developers going out there and getting into these new stuff. We call it geeky, but I find it quite interesting and really sophisticated what they're doing. So we're trying to launch this with that community, with our community of gamers, and with the developers of those games. So it actually makes sense, right? But that's kind of the way we're trying to innovate as a fund.
Yeah, cool. Another thing I thought was interesting, most venture capitalist firms, it seems, they like to either require or expect firms to relocate, to be closer to them. That's why Silicon Valley is kind of what it is, because a lot of firms come there, partly because the venture capitalists request or require them to do that, so they can help monitor and assist those firms that are local. It seems like you guys have a little bit of a different strategy. You kind of invest in firms that are in different countries, kind of geographically spread out a little bit. Tell us a little bit more about that strategy.
That's a good question. I haven't thought about it.
Oh, okay.
Well, I have, because I'm here in Austin, not only for this, obviously, but I'm looking at companies to invest in, right? And probably relocating some of our assets here. Well, not assets, people and working capital. And we understand that being where the companies are is always best, because it's networking, right? You can help them out to deploy certain, I don't know, technologies, or with your network, you can give them access to bigger sales or whatever you can help them out. So we do think about it. Obviously, this fund the unit economics cannot pay for someone in San Francisco, but eventually the idea is to move part of the team to San Francisco and to the central part of, say, myself to Austin. And I can monitor probably New York and all the East Coast. But so Definitely. I mean, we're trying to do that. We know that Silicon Valley is the place, but I was telling Louis from the Herb Kelleher Center that the people go where the money is. So if you're an entrepreneur and you cannot access capital, then you're going to leave. Where are you going to go? Well, Silicon Valley, right? So I was talking to this entrepreneur last time I came, and I'm going to see him tomorrow. And he told me, like, I'm from Milwaukee, and I started this company, and I needed to go to Silicon Valley somehow to fundraise. But my money didn't get me there, so I had to stay in Las Vegas. So
as far as he got. Huh?
That's as far as he got, because rents are lower and all that, and he had to travel three hours per week to go to Silicon Valley. So it made me laugh because it's true. I mean, go and try to live in San Francisco. How much money do you need, or where are you going to live, right? So in the end, Las Vegas sounded pretty nice. And that's the same thing that I've been seeing here in Austin, that he's here because of the Capital Factory, but he's always saying, I think there's no funding here. The Austin Ventures and the venture capital funds here in Austin actually deploy capital in Silicon Valley, and you're like, that doesn't make any sense at all, right? So I think if you have good projects and good entrepreneurs and good money here, capital should stay, and that entrepreneurship scene should grow to compete against Silicon Valley in some sort of way.
Well, speaking of good entrepreneurs, I'm going to put you on the hot seat a little bit, but we have a lot of students, either undergrads or graduate students here tonight, who are either currently involved in starting their own firms or considering doing so in the near future. So would you consider investing in student-run firms, or do you look for a little bit more experience or industry expertise from the founding team as a possible investment?
When you sent me that question, I thought you were thinking about, I thought you were going to ask me about like venture capital firms. So I was like, I don't know if I would invest in a firm, like a venture capital firm out of a graduate student. But now that you say, my English obviously is terrible. But definitely, I mean, I would invest. Remember that it's about the team, it's about the innovation side, and it's about how you look at people and understand what you're doing. So we never not talk to someone because of where they're coming from. I think it's your loss if you don't actually see someone. So if anyone texts me and says, can I meet you, I will definitely give them at least 30 minutes of my time to talk to them, right? You never know when the next big thing is going to be. You won't know if it's going to be sitting right next to you, and he just, I don't know, he's someone that lived on the streets for 3 years and understands perfectly like something to solve a social problem, right? And if you don't give them that 30 minutes, then you're not going to solve it anytime soon. So definitely, I would definitely invest with anyone who's trying to create something from scratch.
Yeah, great.
Even if they drop out, I think.
Well,
those are the best.
We can't say that on. You can't tell students to drop out. We have perhaps a different message. As a professor, I can't do that.
Well,
so stay in school, kids.
No, I mean, if it's their passion. I mean, you've seen all these entrepreneurs that drop out and they're terribly successful. Obviously, they see 3 out of the, I don't know how many millions that drop out and actually end up in a McDonald's serving food, right?
Yeah, sure. Well, I always tell them, too, that the people who struggled never took my class. And so had they stayed in school, even if they were successful, they would have been a lot more successful had they actually taken my particular course. So that's what I say, at least. I don't have any empirical evidence to back that.
I think you're completely right.
I think so, yeah. Ask my students. I'm sure they'll say the same thing. So let's focus on some things that you've seen from firms, either that you've invested in or not invested in, but maybe some mistakes that you've seen some firms who are looking for capital make, and then maybe some positive things that you've seen.
I think the worst mistake a firm can do is actually fundraise more than they need some sort of way. Or think, there's a thing that we laugh about it inside of it. Entrepreneurs never lie to you, right? When they come with a $100 million valuation, they're not lying to you because they're passionate. They really think that they can reach those numbers. But if we believe them, then we're lying to ourselves, right? That's the thing. That's the venture capital does. So if you're thinking that 100 million is where you're going to be, and you actually don't reach those numbers, the most probable thing that's going to happen is you're going to have a down round, right? What this means is you're fundraising at 100 million. Say you do fundraise at 100 million, and next time you didn't reach, probably you reached 25% of your goals. And that's where credibility drops, because obviously the fund that invested in you is not going to invest in you in the next round. And if he does, then he's going to put very severe conditions to the investment. So that really destroys a company, because the entrepreneur now has that thing in his mind that he failed in some sort of way. He's not motivated because probably he's going to be completely depleted in his stock, right? So that happened to us as a firm. That happened to us once, because on our first fund we invested in a Series B round, and we didn't have enough capital to follow on the next one. So since they didn't reach those metrics, then we unfortunately got wiped out, right? And that happens also to entrepreneurs. You have to be very clear on what you want, how you want to reach, and if you have excess capital, then you're gonna waste that money away instead of really understanding where that money needs to go, where it's going to create value, and where that value is going to take you to. Remember that if you're going to make a successful company, what you want is that everybody wants to make money, right? So 1%, 2%, 3% of your stock, if you need to give it out to actually make that happen, it's much better than not to do it, because in the end, the people that invested in you are going to feel that they didn't get a fair value for it. So really, when you fundraise, you have that fiduciary responsibility of making that right in some sort of way. And if you lie to them, then that destroys your personal value, right?
And ability to raise funds down the road or to do other things.
And, and having support from those same investors, right? So I think those are the biggest mistakes that can happen. One more is the advisors can actually, if you get a bad advisor, then it can take your company down the drain too. We've seen it.
So how do you choose good advisors? Excuse me.
It's tough. You never know which is going to be because in essence they're not trying to lead you or guide you somewhere, right? In the end, the advisor is because you think he's going to tell you what's best for you, but remember that those are just advices. They are advisors. You either take their advice or you don't take their advice. It's always on you to actually know if that advice is the correct one. So you cannot blame it on the advisor because they're just giving their advice, and that's why you have them. But then if you only take that advisor's word for it, and you don't look for someone else's advice, then that's on you.
Yeah, sure. So what are some best practices you've seen? Some companies that have been able to be successful in either raising money or just being successful in general. Some kind of home runs.
The team. The best advice is just focus on the team. Invest in the team. Obviously, I'm saying not to throw money out, but really, if you think that CTO is going to be the best thing that's ever going to happen to you, don't push it. If it's $5,000 more a month, but you know that this guy is going to take it to the next level, just do it, right? And that capacity to actually manage those people is the best thing that can ever happen to you as a firm.
Great. So this might be a little bit painful, but I want to hear some of your misses. Is there one miss where either a firm that you invested in turned out terribly and you regret investing in them, or one that you didn't invest in that did spectacularly that you kind of kick yourself for not jumping in? But do you have anything jump into your mind that maybe wakes you up in the middle of the night screaming that you missed either one way or the other?
No, well, on our investment side, since we haven't done a cycle, I mean, when I say a cycle is we're 4 years old, right? We still have 3 more years to go to exit our companies. So the firms that came up to us with an opportunity to invest in, they're still young. So we're not Horowitz, who has 20 years in the market, right?
Sure,
so we haven't seen that cycle. There's probably one, but since there hasn't been an exit, we still don't know. It can go south anytime soon. Obviously, mistakes we have done. Overvalue, we're just starting, and the one I just told you about, the wipeout. But we still believe there's a lot of outcome that can be valued on the next couple of years. So it's not a complete write down. And the write-offs that we have were very low scale, so they were like 1% of the fund. So it doesn't really matter much.
Sure.
So
sure.
I can't answer that question on a very specific note because we're still very young and we still have 3 years to go, which are, I think, the most important for the fund.
Yeah. Well, hopefully the best is yet to come.
Yeah.
Right? You sure hope.
Fingers crossed.
Great, great. Well, I'd like to open it up to the audience now to ask some questions. We have some time to anything. We asked to use the microphones here just to line up, and not everybody all at once, but one at a time. Just come on up. Don't be shy.
Don't be shy, please.
Thanks for being here. So since you're investing in early stage companies, how do you think about valuation as opposed to like investment banks whom are doing M&A for like existing businesses?
That's a good question. I mean, investment banks and private equities have something to grab on. So you can grab on assets, you can grab on revenue, you can grab on EBITDA, you can grab on a lot of stuff, right? And there's a lot of, when you're calling investment banks or private equity, most probably there's a lot of comparables out there, right? In venture capital, sometimes there's not, right? Because most companies that come to you are
Pre-revenue.
Yeah, pre-revenue, or really on an innovation side, it's completely new, or you're this close to understanding it, but you're actually this close to understanding what's behind it, right? And you can value a team very well in an investment bank because their execution is very strict, right? On venture capital, what is your background? Probably 2 years of being in operation at most. So I would say that investment banking and private equity is very standard. It's very like everything in finance, right? You do a WACC and you know how much the cost of capital is and you know how much the cost of debt is and all those comparables. And you can reach to a very specific decision. When it comes to venture capital, what we say is you really have to understand like some of the metrics and where you're going to head at, right? It's very difficult to value because sometimes it's, what's your business model? Well, it's actually nonprofit. Wow, how can you value that, right? And they're valuing at $100 million, and you're like, how can I value a nonprofit at $100 million? And it's actually then you have to go into how many people they're looking at, right? So it's really tough. There's obviously a lot of information out there, like TechCrunch, and there's a thing called PitchBook, and there's several research that we have at our disposal. But sometimes you have to match the best to the best comparable, right? And sometimes they're really skewed. So it's really more of a hunch. Well, no, that came out wrong. It can't be that if.
Educated guess, maybe?
No, that's even worse, I think. No, because we actually do a lot of numbers. We actually try to put something together because if it's a no, you have to give feedback. For at least ourselves, we try to give feedback to the entrepreneur why we're not investing in them. I think that's valuable for everyone, for us and for them. So we try to get the best information available to us. We try to understand what the growth of that valuation might be on the future, right? And through that, we take a decision if it makes sense to invest. Let me put an example. Say you come to us with, I don't know, have you heard of Casper? Right? So say we're replicating that in Mexico, right? And you come to us and you say, well, Casper reached this and our valuation is $100 million. And we don't understand the market and we believe them, right? But guess what? We do understand the market, and we know how many beds are made and distributed in Mexico or in Latam. So you try to reach the maximum available market that you have, not the total. It's the addressable market, not the available. And through that, you know how much sales you're going to get. And if the valuation that you're putting right now through the sales they have or the few sales they have doesn't reach to something that you feel comfortable, like an ROI, return on investment, a 5x or a 10x or a 15x, then obviously you cannot make it, because for us it doesn't make sense. So there's a lot of other kind of things that, or valuations or analysis that you make to actually know that if an investment is right. Dilution is always important. I mean, if you're evaluating someone and you're diluting them 50%, well, there's something wrong on that valuation. If you're diluting yourself, if you're buying 10% for that, then it depends. So it's a tough question. I don't know if I answered it correctly.
Thank you.
Yeah.
I wanted to ask, what was the most difficult thing about becoming a venture capitalist coming from an engineering background?
Wow. I have to.
Spoken from an engineer.
Yeah, yeah.
Right? So, yeah.
That's a good question. I went out of civil engineering, and I knew I didn't want to be in a construction site. No. Why? Because that wasn't me. I wanted to understand how everything worked behind that. So before I graduated, I obviously started looking for work, and I interviewed at construction sites and construction companies, and firms. But I also started looking at private equities that specialized in construction or development. So something that I didn't have in civil engineering was financial planning or financial education. So I tried to learn or grab my technical capabilities and apply them to a financial thing, right? Which is easier because we understand the numbers quite well. So understanding how a DCF comes in or like a valuation comes in, it's easier because we can actually see the numbers before they happen, and you can bring them to a now, or try to mingle them around and say, this, if you add 2 + 2 = 4, right? So I immediately went into private equity, thinking of trying to gain those capabilities, and obviously understanding the core of what I just learned in undergrad.
Were there any difficulties? So you just said that engineering kind of helped you become.
Well, the difficulties, I think it's just trying to, they overcome when you're available to gather feedback. Obviously it's difficult, but I think it's more difficult for a lawyer to go into venture capital, right? To try to analyze, because a lawyer, in some sort of sense, what we understand in numbers, they understand it in words. They understand it in commas. So in the MBA, immediately you know who's struggling a little bit more. And for us that come from a more technical background, have fewer reasons to dedicate more, because it's very focused on the financial side. I don't know if it makes sense, but to your question, the difficulties, I think it's basically that we're used to numbers, and sometimes the investment is not always numbers. It's actually reading people, and that's kind of difficult, because we're really into solving a problem, not understanding others. And that's something I had to grow on, and still am, and I still will be for the rest of my life.
Thank you.
Yep.
Thank you so much for coming. My question is that, is valuation different in a country like Mexico as compared to a country like US? Because there's a lot of political and economic situation. So how do you address those things?
That's a good question. We don't actually put political risk in. I mean, obviously, if we're in investment banking, you do, and you're being very diligent. And if you're an American investor, you do it. But if you're a Mexican investor, it's like, and you're investing in Mexico, it's difficult to say, I'm going to put a political risk in, because you actually live there, right? But the value, going back to the question, I think if I understood correctly, is how do you value differently in Mexico or in LATAM than in the US? I think it all comes down to the numbers. The numbers are in dollars. The other ones are in pesos. There's really no way, because that's what you're looking at. The political risk, well, it can happen in the US. I mean, you've seen Uber struggling in some of the states, right? And when you value the company of Uber, you don't take that in mind, because you think that the US is obviously open to innovation, right? You've seen Uber struggle because of all that lawsuits and all that happening. How can you value that? It's really difficult, obviously, to put that in mind, and that comes afterwards. They're having a down round right now that people are trying to buy 30% off of their previous valuation. So Mexico is the same thing, and LATAM is the same thing. You really look at the people. They give you the number, obviously. When they come in, they don't tell you, like, give me a price and let me see if I agree. They come in, hey, I'm looking for this amount of money, and this is my valuation. And from that, you dig in and see if that makes sense. In the US, it's the same. They come with a valuation, they come with a number, and with that, you try to make your best available analysis and know if that makes sense as well. So in regards to valuation, Mexico is definitely lower than in the US, so a multiple it could be lower in Mexico because of the access to capital or exits or all that, but it's more difficult to penalize something when you don't actually have the exits in Mexico to validate what's happening there. I don't know if that makes sense. So here's the thing. Venture capital in Mexico has been around, but it's actually growing in the past 7 years, right? So as I was saying, we don't have a cycle yet. And 95% of the venture capital funds in Mexico and LATAM, well, not all of them, 95% haven't had a cycle yet. So it's really difficult to understand how everything's gonna move if the companies haven't been sold yet or haven't been acquired.
Thank you.
Yeah.
So I have a two-part question, but what would your advice be for an undergrad student that's interested in getting involved in the VC space, or just more broadly, what would your advice be to just kind of your first jobs out of school?
Well, VC, as I said, is really, I think it's the competitive landscape of trying to apply to a VC is huge, right? So they're looking for rock stars, same as investment banking. I would say, and I have younger cousins that are like between 25 and 20, and I've always told them, when you're young, you don't have many risks, really, right? So you don't have a wife, you don't have kids, you still have the support of UT or the institution you're studying in. So I myself, what I always recommend is you're gonna be, if you just go directly to a VC and say, hey, I wanna work with you because I studied finance, you're competing against probably thousands and thousands and thousands of other people that are trying to do the same. But if you actually, like what I see is, if you have an idea and you try to create it within the undergraduate system, right, with Scott here and all the people, faculty, and you actually demonstrate that you really tried to create a firm or something, that adds a lot of value. So, for example, and we talk, my partner and I, and obviously some other associates, we talk about this a lot. Like, who would you rather hire, right? Someone that's been an investment banker for 3 years, right? Who only knows about numbers and valuations? Or would you rather hire someone that's been really trying to start something from scratch? We always go for the person that's trying, right? But really trying, not like just trying because I just said it, right? But I mean trying, passionately trying. So I really started this. I dedicated a year and a half of my life to this, and I grew my team, and I completely failed. Wow, what did you learn? Well, I learned to fundraise. I learned to manage people. I know I knew how to create something from scratch. I'm thinking outside the box. That's what I want, innovation. So venture capitalists need to, as we were talking recently, we need to innovate. We need to have the brightest people and the people who actually want to be part of something greater. We're not only investing, we're actually trying to invest in making something greater, right? So I would say, really think about why you want to go into venture capital. If it's only because you want to learn about all these companies, which it's a good answer. But do you really want to change something? And if you want to change something, believe it in yourself, I think. So what would I do? I would definitely go out and tell them why you want to be there and demonstrate how you are different from the 2,000 or 20,000 other people that are trying to apply to the same job.
Thank you.
Does that make sense?
Yeah, no, that makes a lot of sense. Give me a lot of good ideas.
Yeah.
Hi. So my question is, if a startup is in the stage where they have a prototype and they're looking for funding specifically to scale up production, would it be smarter to look towards crowdfunding or venture capital?
It depends what kind of product. Well, obviously, here's an advice. I'm not sure. This is my first answer is I'm not sure. It depends on what the product is and what you're trying to sell. If you're trying to sell a software, I would go like crowdfunding. I don't know if the software is good for a crowdfunding platform, right? But if you're telling me there's a watch that makes you fly, wow, right? Crowdfunding sounds pretty awesome, right? Have you seen those skateboards going around? If there's a tangible product that you're going out for, the craziest story of a crowdfunding is someone wanted to make a potato salad. And I'm not kidding. Do you know the story? Mm-hmm. And this guy said, I want to make the greatest potato salad. And he crowdfunded, and he sold, I don't know if it was 200 grams or whatever, for $5. And he fundraised $2 million of potato salad, right? He didn't know what to do, and he actually made the potato salad and started sending. So crowdfunding is very specific on product.
Yeah, once he got it, he said, now I need to learn how to make potato salad.
Exactly.
Yeah, exactly, right.
Where I don't know how many people, a million people wanted to potato salad. So it's a crazy story, but it's a product. Crowdfunding is very good for that. You have to demonstrate something. People think it's really easy to crowdfund. It's actually very complicated. And it also takes 6 months because you have to create a network. You have to create a marketing strategy. You have to create the actual product. So it's selling to crowd, not selling to 2 people sitting in the room, right? So you actually have to put a story behind it. And that story takes a lot of time, and it also takes resources. So I don't know what your product is, but if it's something that's really great, and you think that it's something to actually scale, but on a large scale, then yes, go to a venture capital. If it's like a product, for example, we have a company that we invested in called BlueSmart. It's the baggage with Internet of Things in it. So you know where it is, and so it's intelligent luggage. These guys did crowdfunding. They also have venture capital funding, but they sold $2 million in luggage in a month, right? So you can do both if it's a product. But if it's not a product, I don't know. I have never seen it, or at least I don't remember. Does anyone know if there's a crowdfunding that has done anything other than a physical product or a
Well, there's lots of different kinds, but some artists will raise money to do a movie or a CD or something like that.
Yeah, but there's something coming out like people can watch and relate to.
Yeah, usually there's something tangible that comes at the end, right? Yeah.
Okay. Thank you.
Happy to discuss afterwards if you want.
Okay, thank you.
Hello. So before this presentation, I've been reading about how to define what is a meaningful VC exit. I've read that it depends a lot of the size of the VC, but in your case, what kind of parameter do you use to consider if you did a good investment? Or
so that's
because I have
for
read
my
that,
firm.
Yeah.
Or would you?
I've read that many of other VCs things like the rate of return or
Okay,
three
gotcha.
times gross
ROI.
return,
Yeah.
something like that.
That's a good. I mean, depends on how you see it, and there's a very good story about Andreessen Horowitz. So they invested in Instagram in 2010, right? They invested $250,000, and they got back $75 million for that investment.
It's not bad.
That's not bad.
Yeah.
Really not bad.
No.
Right?
That's the expectation I give for
Yeah,
my students
exactly.
as well.
300x, right?
Right.
And you go like, wow, that's great, that's awesome. But the fund is $1.5 billion, right? So you're talking about 5% of the fund being returned in one asset, right? Obviously, disclaimer here is they had a conflict of interest on that investment because of other, but if they have invested further in, they would have gotten out like $750 million with $40 million investment. So for us, it's really important the return on fund, not the ROI. Obviously, the ROI is, we see it at least for a, if I'm an angel investor, right, which I am, I'm looking for an ROI. I'm looking for a return on investment, right? IRRs, well, obviously, you're looking for a quick return, so that increases your IRR. It's completely right. But if you're a fund, you cannot look in ROIs because you can make, wow, 100 times your money, but you still owe your investors 90% of the fund. You're kind of not there yet. So what we look at is the return on funds. So if we invest in a company which is going to give us 1x our fund, wow, that's great. Doesn't matter how much you invested in, right? But if that returns 1x your fund, then you're safe. You can give them back their money, and everything that comes on top of that is gravy, right? But if you get ROIs of 100, that's the shotgun approach, which is 100, 100, 100, 100, and to reach 20 Instagrams, well, good luck, right? So for us, it's ROFs, and there's a lot of ROIs going around, and the IRR, that's what we call like a beauty thing, but in the end is, if you invest your money now, how much money annualized is going to give me, right? And that's how VCs are basically valued at. So if you're in the top quartile, then you're on the top quartile of that vintage fund, how much they're giving back to their assets. So how we are valued is on IRR returns, but how we value ourselves, which is basically related to the IRR, is on the return of funds. So
Thank
it's
you.
a little bit, it has to be both.
Yeah, cool.
Okay, thank you.
Yep.
So you mentioned that the most valuable thing you look into in entrepreneurs and a company is a team. So I wanted to know if you would like consider investing in a search fund that it's probably like investing in people, and also your perspective in the search fund in Mexico and in the US. Like.
That's a great question. Yeah, because we've thought about this a lot of times. Obviously, our investment approach is not investing in search funds. Why? Because it has to be something in technology, and it has to be a team, right? Obviously, a search fund involves an investment now, but those people are going to look for something to invest in. So through the company building, we started a strategy that's called Inception Fund, which we're kind of in the middle of deploying. So we did a lot of company building ourselves, but we realized that starting companies is quite a pain. It's complicated, and then you have to find a team, right? Which is the most, as you said, it's what we invest on. So now we have to find a team to actually deploy. And that's a lot of capital in between. So what we're trying to evolve to, and again, innovating in the way we invest, is we call it the Inception Fund. It's a search fund for entrepreneurs instead of search fund for funds, for fund managers. So I was talking to Van, which is, I think she's around from the OTC, and what we do is we basically say, come to us, what do you want to do? What are you passionate about? No? And I put the blockchain, right? I'm passionate about the blockchain. Well, the blockchain is huge. Nobody actually knows what the blockchain is yet. But I love it. I think I have the capabilities, blah, blah, blah. And we say, okay, that's good. So we give you money, we take part of that company, so obviously we make you, we do everything legal and everything. And once we invest in, you have 1 year to bring us something. And what I mean with something is you bring a team, you bring the research, and you bring a viable idea to actually make the follow-on investment in. So we seed fund you afterwards. Does that make sense? So the search funds in Mexico and US, in Mexico, what I've seen is they have not been very profitable in some sort of way. Because why? I mean, in general, private equity in the past few years, the private equities haven't been successful much. So it's kind of the same thing. I know it has been growing in Mexico. Now I see I have friends doing search funds and all that, and some of them are successful, most of them aren't. So it's a great idea. I think it's great, but then it's people who don't have management experience buying a company and trying to make it work. So that's kind of our thoughts there is, it's happening the same with private equities. They think that because they have the money, they can just crunch their numbers and their management and just make it more profitable. But what you're actually sometimes doing is destroying value because you're not an expert. Hey, private equity guy, have you ever managed a company like this big? I don't think so. They come from investment banking. So that's what I think a search fund lacks. So my thought to you is, if you want to do a search fund, first gain managerial experiences, obviously with the background of finance and whatever. And once you understand how to manage people, then do your search fund, because you're going to be able to actually manage that company.
Thanks.
Yep.
2 last questions here, and then we'll go.
So my question was, you mentioned Bitcoin and Ethereum and some other blockchain technologies. I was curious to see how those impacted Mexico's financial markets, and how do you expect to see that change compared to United States?
I love this. There's only one exchange in Mexico, and these guys are filthy rich. So I'm jealous in some sort of way, right? And it's a jealousy because we're trying to make it, we see this grow. The financial markets, there's still not a regulation in place. Not in the US, not in Mexico, because they basically don't know where the money is. And now it's disappearing from their bank accounts and going into somewhere that you cannot really track them, right? Financial institutions are not getting there yet because we're like 15 years back in everything, right? Which is great for us because we can actually take advantage of this. The only bad thing is when they feel that something's not right, they just put a regulation and they completely extinguish that probability, right? But if you take your money out, then the thing is just bringing the money in. But if somehow just appears in Japan, then who's going to catch that, right? So I think there's huge opportunity in Mexico. Well, there's obviously uncertainty, huge. Nobody knows who Satoshi is, for starters. People say it's Elon Musk, then he says it's not Elon Musk, and then nobody knows, and then you have Vitalik, who's obviously frustrated with his life as well. So it's just genius people trying to get rid of the financial institutions. Financial institutions have been around, they will be around for a long time, and some of them have gone up. You saw the JP Morgan guy say that Bitcoin sucks, and suddenly it drops, and then 3 weeks later it's twofold. But then again, who's mainstream? Who's not mainstream? Is Bitcoin worth it? I don't know, but here's a curious thought. Only 0.1% of the population, entire world population, has a Bitcoin, an exchange account, crypto. The value of gold is, I think, 3 trillion, I think. Billion, well, at least cryptos are 250 billion. So what's more valuable? Something that's there and doesn't really add value, just a piece of metal, right? Or something that actually creates value, which is transparency on transactions, right? Like Ethereum is. So back to your question, I love it because we can stay here for like 3 hours or 6 or the entire night and grab beers about it. But in the end, the financial institutions they're going to have trouble because it's not only about tokens and money. It's also about a valuation of a company, right? So Ethereum, what it's valuable, it's not the actual Ethereum, because you have Ethereum Classic, which is basically the token of it. But Ethereum is the entire concept of what he's trying to build, right? Then you have Bitcoin, which is just a coin. No, it doesn't have an intrinsic value. And people it's like somewhere in the middle, the dollar goes up to $1 billion. Why? No, is it because the value of the paper, or is it because the value of the country itself? So that's a huge question.
Thank you.
Yeah.
All right, last quick question here.
Yeah.
And a quick answer then.
Yeah. No worries. No worries.
So I was wondering, with a lot of big companies starting to use acquisitions as a form of R&D, how often, from your perspective, are you working with companies with the thought of acquisition in mind, as opposed to simply growing it into something that stands alone? And also, how often do you actively seek out companies that might be interested in something like that?
It depends where you are, and it depends the kind of company. Here's the thing. In the US, you obviously have availability to do an IPO, right? Because volumes are bigger, credibility is higher, and you have actual resources, right? And you have private equities that actually buy companies. So in that sense, when we invest in the US, we rarely think about, hey, let's do an M&A with these guys, right? Because you actually think that it can be a standalone. But sometimes the technology is something that someone else wants, which is a great way to do an exit too. They pay the same valuation, right? You're not getting less because it's a strategic acquisition. You can actually get a higher valuation. But in Mexico, going back to the exit strategy, we do actually have a strategy for harvesting. What this means is we do go out there and we think, well, the only option is for a strategic or an M&A acquisition right now, right? Because valuations don't go up to $500 million. They stay at 50, 70. But at 70, you do an IPO, and then you have a float this big, and who's actually going to buy that? And then people are not sophisticated enough, and the ones investing in the stock exchange market is probably 2% of the population, rather than here in the US that you have a higher population and more accessibility for cash. So it depends on where you are, but I think it's always very important for us to look at strategic or M&A exits, because we have cycles. We need to, after 7 years, we have 2 more years to actually sell those assets. After those 2 years, we actually have to not write them off, but say, here's your shares, and then we're out, right? So it's very difficult for us to do that. So we really have to focus on selling that asset if we don't see that probability of doing an IPO or standalone and management buyout or a private equity buying out our shares. So we do have to harvest that from the beginning, more in Mexico and LATAM than we do in the US, but we do see that in both countries, well, in the world in general.
Great, thank you.
Thank you.
Great. Well, thank you, everybody, for your time and attention this evening, and thank you, Andres,
guys.
for your insights. We wish you the best. And good luck in building the next great companies for the future.
Well,
we
thanks.
do have some refreshments out front, so stay, please, and eat and mingle, and we'll stick around to answer some more questions.
Thank you
very
Scott.
much.
Thank you, guys.